Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you, Martin? Coming to us all the way from the UK.
That's right. Yes, DAFA HQ currently is in Bath in the UK, but still the same old. Still doing the same economic analysis and YouTube's and everything else. But just spending some time with family and friends and visiting places in Europe I've not been for years. So it's quite nice just to have a bit of a change. And I was here for the coronation, and we've got cricket shortly, and Wimbledon, and a few other things all teed up. So should be a fun few weeks.
Sounds pretty good. You definitely deserve a bit of a break, Martin. But as we said in the pre-interview, I'm glad I've got good internet over there because we're literally on opposite sides of the planet, and you look better than me, I reckon, with that internet. So good
Yeah,
stuff.
well, I mean, I'm on my portable system, so there'll be some other stuff arriving a bit later. But I basically brought with me what I could carry on the plane. So it's one camera, one microphone, and a PC. But thankfully, the internet connection's pretty good here, and so far things have worked really well.
Awesome. Any general thoughts? It's been 2 months. We gave you a month to settle in, but on what's been happening around the world generally?
Well, I think chaos. I mean, anybody who thinks that we are out of the worst and that we're now into the sunny uplands of economic stability and political stability and no. We are facing into a number of significant risks, and we'll touch on some of those today. And what I find really interesting is that a lot of the analysts keep changing their tune. We've got lots of volatility in the markets. We've got lots of uncertainty, both politically and economically. And even the budget that came through this week in Australia, if you read between the lines, there are some really worrying cracks there about deficits into the future as well. So yeah, we are in a very, very uncertain set of times. And look, anybody who thinks that they can call this and know precisely what's going to happen, I think they're kidding themselves and everybody else, frankly.
Yeah, I often say to people, and just look at places like Paris, France, where there's these ongoing crazy riots, and that it's kind of happening in slow motion, where people are starting to feel the pinch and waking up to everything that's been going on the last few years and whatever. So even if house prices go up or stocks go up a bit or whatever, it's very different to what's happening in the real world
Yeah.
as they try and paper over those cracks.
Absolutely. And, I always say to people, repent at your leisure, make sure that you understand what's going on. But sometimes doing nothing is better than doing something and then making the wrong decision and regretting it later. I'm seeing that, for example, at the moment, a lot of people in Australia are desperate to try and buy a property. And I'm saying, well, hang on a moment, maybe that's not the smart strategy. So I'm not saying don't buy, but be cautious and careful and understand some of the risks that are going on at the moment. Because look at banking. There's banking crises developing around the world. Risk of recessions rising. I think stock markets are probably set for another fall ahead. And frankly, central banks continue to just show me that they don't know what they're doing.
Absolutely. Let's dive into these fantastic slides of yours. So Australia's residential property wealth comparative to other countries as a percentage of the wealth in a given nation or whatever is crazy high.
Yeah, this is from CoreLogic's most recent presentation. And it just, for me, it screamed a problem, right? We've got 10.9 million dwellings, but we've got 56.1% of household wealth in housing. That's one of the highest in the world. And frankly, if you compare it with stocks and superannuation or commercial real estate, we are so over leveraged to property, and that really highlights for me one of the critical issues, which is that clearly the Reserve Bank and the Treasury are going to be very nervous about doing anything that might in any way dent the housing sector, because if the housing sector took a dive, then the US will probably get by, but Australia wouldn't if the housing took a dive here, because we're so leveraged. Our banks are so much into property, households are so much into property. So expect to continue to see more unnatural acts to try and support property. We saw those in the budget again. So, but this is the reason. It's too big to fail.
Yeah, and I want people just to keep that total sales per annum figure in their head of 470,000 as we move through these slides for later on as well.
Yes.
It's going to become important relative to some of these newer schemes and whatnot. But 3 months change. So we have seen a bit of a bounce, mainly driven by Sydney and the capital cities.
Yeah, so this is the latest. Now, of course, there's some lags and delays in the data, and I think people are probably reading into this probably too much, but it's mostly a Sydney thing. You know, Sydney was up 3% over the quarter. But again, you have to go granular because not all postcodes have the same movements. If I look at some of the regional areas in and around New South Wales, they're still going backwards. But there were some areas in Sydney where there was a bit of a peak. In fact, first-time buyers, as we'll see in a second, did come back in a little bit. But there are still significant pockets where prices continue to slide. And with interest rates continuing to rise, of course, the RBA put the rate up again this last time around. My expectation is that this is going to snuff out any significant recovery in property for the next 2 or 3 years, which is going to be a big deal.
Yeah, and retail sales have slowed. So this is another example of kind of what's going on in the real economy rather than just what the punters are doing at the housing market level.
Yeah, and this is important, right? Because, of course, what people are doing is spending less because they don't have the money that they had and they're raiding savings or putting more on credit. But yeah, retail sales volumes are down. And remember that inflation is still raging. So, bearing in mind that this is not inflation corrected. So effectively, in real terms, people are actually even worse. In other words, they're spending a lot less. They're actually being picky about what they're spending more on food, and obviously spending more on power, but less discretionary stuff. They've also spent much less now on travel. So there was a spike in travel over Christmas and New Year. That's now dropped off as well. So that's really changed. This is one of those leading indicators, looking backwards but pointing forward, that suggests to me that we are going to see more significant economic pain in the country because these rate rises are going to continue to bite.
Yeah, absolutely. Cost of living. So building approvals, as you mentioned before.
Yeah, so there's another example. Building approvals continue to slide, and of course the HIA came out and said, "Oh, this is disaster. We're not building enough property." Of course, the property and construction sector keeps saying, "We need to build more property. We need to build more property," because they want to feed the beast. Now we've got a migration number, something like 700,000 over 2 years, according to Treasury. So we're going to see more people coming into the country, feeding the beast. Remember what we said about property being the fundamental platform that's driving the economic prosperity of Australia? Well, not surprising. But at the moment, less approvals are coming through. It takes perhaps a couple of years for approvals to come through to more construction. So the chances are that the supply of new property will continue to ease back, and that's going to have a significant impact on, who can buy, what can buy. And the other point, of course, with those migrants, they've changed some of the parameters so that people can become permanent residents more quickly, and that means they can buy property and all those things. So everything is geared to try to actually protect the property sector.
Yeah, that was the point I was going to get to as well, as we saw that 470,000 sales per annum figure. If we've got migration that's on target for 350, 400,000 new people coming into Australia, it's easier for them to buy property. We've just heard about that new scheme they want to do where you can now buy a house with a sibling or a friend. So if we have all these new buyers and people coming online at a time when we see these dwelling approvals falling, and I kind of see the parallels to the smaller regional banks in terms of the smaller regional builders. And even if it's just the confidence of the guys I talk to that are tradies going, yeah, it's harder. And we're hearing about these firms falling over. So they're going to need to ask for more money. Or if they take over a job that's half completed, they need to reassess it. And that costs more. So this is all inflationary. And so it's going to get harder to build houses, get houses, and the ones that do are going to be more expensive. So this could be a sort of scenario where things are really bad in the real economy and the average person, but there's just not no new houses to take all this immigration and this new wave of people that can finally get a bigger first home buy grant going with 2 people. Remember we used to joke about it's going to take 3 or 4 people to have a mortgage and it's going to be a 50-year mortgage. Well, this is kind of the first step in that direction.
Well, all the levers they've pulled are all in the same direction. So higher migration, as you say, you can, club in with somebody else now to get a mortgage. The banks, of course, are desperate to lend because we'll see in a second some of the lending statistics are pretty weak. And it goes back to what I said, and that's why I started with property, because people need to understand that of all the games in town, the property game is by far the most significant in terms of economics, politically speaking. And also the construction sector, of course, are huge lobbyists in terms of actually pushing politicians a particular way. But one of the interesting observations is the number of failures in the construction sector continue to rise. It's one of the worst sectors. The number of bankruptcies are continuing to rise. And we're also seeing that the cost of construction is still rising very fast. So as you say, there's a real problem when in fact to build something new is going to cost maybe 20% more than it was a year ago. That's going to put more upward pressure in some areas. On the other hand, if you look at borrowing power, in other words, how much people can borrow, that's dropped dramatically by about 30% compared with a year ago because of the higher interest rates. So you've got this really weird dichotomy between where the lending capacity is and where the building costs are, and that's going to put more significant pressure on both the construction sector and also on property.
Absolutely. Moving forward. So you've already mentioned lending a little bit there, Martin, but some of these granular charts in terms of investors and whatnot are interesting.
Yeah, so it was interesting because everybody said, hey, lending jumped up. First time for months, right? We actually saw quite a slight increase. But if you look at it, the reason partly is that we've got massive amounts of external refinancing. People are still trying to get cheaper mortgages, and people are, frankly, if you've not checked your mortgage rate in the last year or so, you're probably not on the cheapest you could get. Assuming you've got a reasonable loan-to-value ratio and a reasonable credit history, people are shopping around, and that's why the external refinancing is huge. There was a little spike up in terms of first-time buyers. Now, that's firstly because of some of these incentive programs that are coming in, and also, of course, last month the RBA did stop lifting rates. And so some people were calling that as the bottom, effectively things were going to go improve from this point. Property spruikers, particularly, of course, were celebrating the turn, but we'll see. I suspect that the RBA lifting, very recently will snuff that out. Confidence dropped again, according to Roy Morgan, and certainly in my surveys, I'm seeing a lot of first-time buyers who now can't afford to get in. And many people are now saying, well, maybe I'll just wait and see how this is going to play out. So I expect these lending trends to remain weaker. But of course, the spruikers were talking it up like you wouldn't believe.
Yes. So mortgage stress has stabilised a little bit as well.
Yeah, so this is really because people have been able to refinance. And when you refinance, in some cases, people have been refinancing and extending the term of the mortgage. And that means that the monthly repayments are lower, or they've refinanced to a lower rate. And that's given people a little more wriggle room. Plus, we have seen some slight increase in terms of wages growth for some people, and that's helped a little bit. But the problem I see is that with the inflationary pressures where they are, and with the costs of power going to rise significantly, and I know that the budget, we'll touch on the budget shortly, the budget sort of offered some help, but not enough to make really a lot of difference in my view. So I expect to see the rental stress continue to rise. Mortgage stress came back a little, but will probably rise further because we are still to see the full impact of all those rate rises that came through. And we've still got this massive switch from fixed rate loans to variable rate loans. And in fact, July is a peak month. So I expect July, August time to see mortgage stress unfortunately even higher. Remember, I define it in cash flow terms, money in, money out. It's not the same as defaults, but it is saying that there are more households under financial pressure. And in fact, NAD came out and said they think about 40% of their borrowers potentially are now trapped with the mortgage they've got because they can't refinance. So things are getting quite serious.
I think one of the other things we've probably both spoken about on our channels over the years is how the government are going to start to pick up and foot more of these bills for different things and thinking that it's going to be temporary. And we've seen in different countries there's been fuel handouts or grocery handouts, and this chart really exemplifies it, doesn't it? How much rental stress has outpaced mortgage stress, and that was one of the big things that was targeted in the budget. But if you're going to hand out X amount of dollars 1 year and inflation continues to trend higher, you can't really take that away once you start giving it out to people.
Well, that's right. And of course, the interesting debate now is whether, in fact, the budget was inflationary or deflationary. So will it actually ease inflation a little? But I think only a little bit. A 15% increase in some of the rental support sounds like a big number. And of course, ABS says rents were going up by 4 or 5% per annum, but in fact, new rents were at 15 to 18%. So it's not going to touch the sides. This won't be sufficient, in my view, to solve the inflationary problem. It might actually create more inflation. The rental sector has just fallen over. The number of listings are still very much down, and people are having to spend a lot more just to find summer housing. So housing affordability is a critical issue. I'm afraid the budget, I think, really didn't do enough to be able to really make a significant difference. But they can at least, politically say, well, we did some things, I suppose.
Yeah. All right. So, any adjustment to these scenarios after the most recent rate hike?
Well, just to highlight the fact that, of course, now the assumption is the best case will be that they don't actually raise rates anymore. 3.85% is it. CBA is saying they think that's it, but then CBA has consistently under forecast the forward rates from the RBA. The RBA in their recent statement on monetary policy did say that they did expect potentially to have to lift rates higher, but they would be data driven, which is why some of this data is so important. My base case scenario is that they will have to raise at least once more to 4.15%. That's a mortgage rate of 6.5 to 7.5. It's going to stay in that range for some time, because the second thing is the markets have been predicting significant falls later in the year. But with inflation still sticky and still high, I can't see how the RBA can start cutting rates until probably 2024. And in fact, their forecast is they won't be hitting the top of their inflation band until 2025. And I'm also assuming my base case, no recession in Australia. I think that's looking more wobbly because, as I said, the data is looking more negative. And therefore, the worst case scenario would be that rates go higher, but then they actually come down, but they create a recession in the process. And, looking at those numbers relating to retail and construction and those things, these are all negative indicators. And we'll talk about some of the assumptions that the budget made in a second, because they are pretty heroic. So to my mind, my base scenario is still where I think it's likely to be. But, maybe the best case scenario is that the RBA doesn't lift again, but we'll see. They're going to be data driven.
Yeah, and we've got that chart now just showing people the percentage drawdowns we'd expect in the best and worst case scenarios.
Yeah, and just to say that, on a good scenario, prices will stay pretty much where they are and go up slightly. But on the worst case scenario, both units and houses would drop. And, remember that prices relative to income are still way off the scale. And whilst there have been some changes to lending standards and some underwriting to try and give people more flexibility, longer term mortgages, interest only, etc., the fact is that people are spending too much of their income, if they've got a mortgage, on their property, particularly if you've borrowed recently. And in fact, now we're starting to see reports from the lenders about expecting higher levels of default later. So they're actually provisioning more, and they're talking about more stressed households in their portfolios. And in fact, on the next slide, which really sort of highlights it, the banks are now preparing for higher loan losses. And that was one of the 5 shocks that I'm seeing. They are going to have to expect higher loan losses now, because this is going to flow through. Not immediately, it will take some time. So typically people can muddle through for a few months and then maybe refinance. But eventually they get into the situation where they've got negative equity. They can't actually make their loans work, and then they have to get out. And the banks are still pushing some people to try and get out sooner rather than later, because they don't want the arrears. What they want is to actually get the loan repaid. So I'm afraid that we are going to see a lot of this, and the banks are preparing for that.
Yeah, and another interesting thing you spoke about there was the how the recession would affect those the banks and the forecast in property downturns. And I think the latest stats say the US is 80% chance. I think Australia's only seeing it say 40%. But we've spoken about again how globally everything's so interconnected. And if we are to have a recession in the US, it's probably going to be worse in Europe, and that flows through to Australia, and even just the confidence and sentiment and all that stuff as well.
Yeah, it's clear to me that the chances are US will hit recession. The Fed is still talking about lifting again. Some of the leading indicators were more positive. So the jobs number that just came out was quite positive, but the markets are getting really, really twitchy now, and there is a lot of evidence to suggest that this is going to fall over. It's going to take some time. The question is how quick and how the Fed will react. But again, Jerome Powell was talking about we have to get inflation under control. We are prepared to lift rates high if we need it. And I think that all of those things lift the risk of recession. China, of course, the latest data from China was also okay, but not as strong. And the COVID or post-COVID bounce was weaker than people expected. They're also redirecting a lot of their investment to try and get Chinese people to buy stuff rather than actually importing stuff and then exporting it. So the whole nature of trade around China could be changing. And if you think about the US potentially catching a cold on a recession front, China easing back, those two forces could be very significant for Australia because we are connected, internationally, and the trade numbers could look a lot worse than they currently are. And as we'll see in a second, the budget's actually benefited from much higher commodity prices than people expected, and exchange rate moved positively, but it's not going to necessarily happen again. So, it might be just a very temporary little positive blip in the budget.
Yeah, and pardon the pun there, Martin, talking about China's post-COVID recovery and the US catching it cold. But there's been some interesting numbers come out there in terms of, yuan has now overtaken the US dollar in terms of Chinese-based international transactions, and we're seeing them cut deals, other nations wanting to join the BRICS nations and so on. So, we always hear there's been videos going around, the death of the US dollar, but I think it is starting to pick up that pace of the death by 1,000 cuts, where more and more are saying, hey, not on your terms, we're going to do things our way.
Yeah, so I think that's right. The BRICS thing is very interesting. Of course, holding gold is also now in vogue by China and Russia and a few other countries as well. So the debate is, to what extent will the US dollar remain preeminent in terms of international trade? There are alternatives. Not sure how it's going to play out. I think it'll probably be a bit of a slow burn. But, there are more people now really questioning the long-term trade structures and how it's going to work. And, I think the BRICS thing is actually quite significant. And by the way, I'd say that if in fact we start seeing market falls, and that's my second shock, the chances are we are going to see markets come back. At the moment, the markets are still pricing equities particularly for perfection. And in fact, this chart here, with regard to market falls, shows the relative movement of US techs versus the S&P 500. It's way overstated, overpriced. And so the tech sector is still potentially due for a correction. Many other stocks are also overpriced in terms of future earnings expectations. And so if we do get a recession in the US, stock markets will come back. And, some people are talking a significant correction. They are still overvalued dramatically. And that will have a very significant effect then on the US dollar, but also on, the international trade flows and things. So there are lots of shocks out there.
Yeah, I mean, only thing I'd say is when I see this chart, I just wonder, we know the large US tech stocks take up such a big chunk now of the market, and whether or not tech is just so all-powerful and all-consuming that this ratio is only going to get further and further extended compared to all these other smaller companies doing real things. And if we go into a recession, just like when we kind of went into COVID lockdowns, people that are unemployed are going to be spending more time on social media, and more eyeballs and time on these apps means more ad money for them. And again, it's this upside down world we live in where these big companies can be making money no matter what.
Well, that's true. And, the latest results from, say, Apple were actually quite positive, and there have been some big swings. What I'm interested in is the volatility. So whilst the volatility index has been quite low, the reason for that is that the volatility index is actually on long-term options, but everyone's now trading short-term options. And in fact, they brought out a new volatility index, which is looking at the short-term options rather than long-term ones. But the volatility in the markets benefits the major traders. So if you look at the recent financial results from a lot of the big banks, they've actually made hay because of the big movements up and down, and they can do the the very quick trading and all of those things. But it's not necessarily the real economy. It's not actually creating real value, and that's the worry I've got. That actually, whilst you might still see significant movements in the markets, the risks in the markets are actually getting more significant. And as you say, some of the techs will probably still be there and be generating revenue, but a lot of them are still priced for perfection and are still assuming rates have come significantly down. The future value of those tech stocks will obviously vary based on where the rates go. If interest rates can go higher, then by discounting future flows, they are less valuable today. And that's another reason why I think the tech sector is still the bellwether.
Yes. Okay. So we've probably both done plenty of videos about the banking crisis, but I did read this stat as well the other day about over 50% now worried about, over 50% of capital concerns for these smaller US regional banks as the domino effects may start to happen.
Yeah, and it's worth underscoring, this is not the same as 2007-8, right? Because that was a loan-based problem. This is about movements in interest rates the investment strategies of the banks, and frankly the exposure they've got. So a lot of the banks now have significant capital issues. This isn't just one or two banks. 722 banks, 722 banks in the US, right? Mostly regional ones are potentially at risk. And we've seen SVB, and we've seen other the one last week as well. We've seen some, but we haven't seen the full story yet. And the last one obviously was bailed out by a really big player. Question is, can they go on doing that? If more banks fall over, will the contagion spread? And I've got here the index for regional banks, and it's just showing how much it's dropped relative to a couple of years ago. There's still plenty of downside risk. I don't think that this is over. I think we're just in the foothills of the regional banking crisis in the US. And whilst it's not the same as 2008, it could have significant repercussions, not just in the US, but around the world.
Yeah, I had a bit of a rant in the video I did last week about this, but how was it First Republic were bought out by JP Morgan, and how they kind of get it at a discount, but it's backstopped. So, it's all printing money and bailouts, if they don't want to call it that. But at the same time, we've got Apple launching their savings account. So we've got biggest tech turning into our bank as well. And all this is kind of in the background of they want to roll out these central bank digital currencies, and hand in hand with big tech to take control of everything. It's a really wild time.
It is wild, and yes, the interesting observation there is that central bank digital currency story is developing quite fast. More and more we are seeing more and more people being pushed into the digital environment, which means that they're actually then set up for when central bank digital currency comes in. That means that you've got no control over your own destiny with regard to finance. You can have it turned on, turned off, and the fact that there's a bigger concentration of banking amongst a smaller number of very large players, which is one of the the outfalls of the banking crisis at the moment, what concerns me. I'm not sure that we need to have a great concentration. We are just creating more and more difficulty later. And the old central bank digital currency story is a one to watch, because to my mind it's a question of not just finance but civil liberties as well.
Absolutely. I might comment more on that at the end as well. But we see the credit tightening again.
Yeah, no, this is important because whilst we don't see 2008 playing out directly, what we are seeing is credit rationing. So banks are less willing and able to lend now. And so we've got effectively, they're just tightening the loans to firms in the US, this chart, but it's true more broadly. The cost of funds has gone up. The margin compression is there. The risks in the system are rising. And so what banks are doing is pulling back on their capacity to lend. And we've had a credit-driven economy for the last 20 years. Look at the total growth in credit, both corporate and household and government. Everybody's gone on the debt binge. The cost of that debt is now so high because the interest rates are higher. And that means that the world is really now beginning to, I think, get to the point of peak debt. And that means that the banks won't be able to grow their books. That means they won't be as profitable. The risks are rising. It means that some people are going to be paying a lot more, as we said, for example, mortgage stress in Australia. People are having to pay a lot more. Credit tightening is the thing to watch, because this now has the capacity to create the next wave of uncertainty, not just in the US, but I think in other places too. And in Australia, we're already seeing it. So I mentioned earlier on, the borrowing power of first-time buyers dropped about 30 to 35% compared to a year ago. That's just another example of credit tightening in practice.
Yeah, certainly peak debt, as you say. These credit default swaps rates are spiking as people start to even worry about the US possibly defaulting on their debt. But yeah, peak debt, if rates stay this high, it's just mathematically we can't maintain these huge multi-trillion debts once rates are at 5% or above, as you say.
It's just the interest costs are way too high. And you mentioned the debt limit. This is the fifth shock to talk about. The debt limit is coming. Biden and McCarthy start US debt ceiling talks as the clock ticks to the default. Now, they'll probably play politics with this for some time. Yellen has been talking about the severe risks, and it's worth just looking at history shows us that actually ahead of this debt limit ceiling, markets get volatile and prices move all over the place. So expect more volatility from this one as well. This is going to hit significantly the next couple of months. Another reason why markets are being quite skittish at the moment. And I don't see any reason why that's going to change. I don't see that they're going to resolve this right up until the deadline. They probably will resolve it in some way, but it will always be down to the last sort of few seconds before midnight.
Yeah, it's a bit of a party trick every few years that the debt ceiling ticks around again, and they have a package and an agreement at the last minute. But most countries don't have one. What's the point of it if you're just going to raise it every time you get there, and it's around election time? It's all just fun and games, really, isn't it?
It is, but it is worth just highlighting again how much the markets actually are impacted by this uncertainty. And if the US were to default in its treasuries, I mean that would be a
Huge deal.
huge deal. So we'll see. And then finally, I'll just quickly talk about the budget because it was pretty new. Interestingly, of course, they're talking about a surplus. Well, but it's really just temporary, right? And they've made some significant concessions to help people with their power bills and to help with rents and those sorts of things. As I said earlier on, the question is this inflationary or deflationary? My own read is it's probably slightly inflationary, and the problem is that the power bills are going to rise a lot quicker and faster than this is going to cover. So it's going to help, but not really solve the problem. And whilst it's 15 billion or give or take, it's worth thinking that through COVID, we had 80 billion being spent. So that gives you a little bit of the relative quantum. But interestingly, one of the questions is why have we got this slightly positive number in terms of the budget bottom line? Remember, this is the annualized. This isn't the total pool of debt outstanding, which is still heading up probably close to $1 trillion. And on the next slide, it's worth just looking at that. The spikes really were actually driven by some one-off factors. So unemployment lowest in half a century, workers are in higher tax brackets, corporate tax has been a big contributor because of energy prices and because of coal and natural gas, which we of course exported. We also had the bonus of the Aussie dollar moving from $1.10 to 70 cents, and that created a huge amount of positive when it was translated back into local currencies. And the commodities, of course, are sold in US dollars, so that's positive as well. But the key point to make here, Alex, is that in the red is where we're headed, right? We have a structural deficit problem, which is huge. And whilst Chalmers can claim, well, we're going to be in positive land for a little bit, it's only very, very minor. The fact is that looking out over the medium and long term, structurally we have a real issue. And in fact, this final slide there shows that the major economic parameters show that GDP's on the slide, the unemployment rate is going to rise. Look at it, like it or not, the inflation rate's not going to be where it is. And of course, there's some big assumptions they've made. They've made some assumptions about the level of migration, which is going to continue high. They've made some assumptions about where rates are going to be. All of those are pretty heroic. So I haven't got much confidence in this budget, as I haven't over the last few years. I feel that the Australian economy is headed for a very, very tricky time.
Yeah, I think I read the budget was aiming to reduce the projected debt from 1.1 trillion to about 1 trillion in Australia now. So yeah, we're up towards that $1 trillion mark for a country a lot smaller than many others with a similar amount of debt. But very interesting, as you say. And we even made that documentary a few years ago about how we've had all these perfect tailwinds in terms of ages and demographics and the mining boom and China helping us out and then the housing boom. So yeah, we've had it pretty good for a very long time, but now we've got a lot of debt. It kind of has to perpetually stay at those levels of growth or whatever.
Yeah,
it's just not mathematical.
The debt burden with the interest rates where they are and where they're going to stay, they're not going to come back down to 0.1% anytime soon unless we get a massive recession, which means that the cost of debt, the cost of servicing that debt is going to hit us. And that's going to hit corporates, it's going to hit households, and it's going to hit the government. And so that's why we have a real structural problem. And by the way, the only real reason why, in fact, the numbers came out positive was because, of course, people are paying a lot more tax. So we're paying more income tax than corporate tax in Australia for the first time collectively. And, how much tax should we be paying? Well, probably not as, if we pay what we're paying currently and we continue to pay it, we're about 45% on average. There are other, like Denmark is at 55% of income on average, but it's still very high. And so, unfortunately, we see wall-to-wall debt, we see significantly lifting taxes, and we basically see a significant problem for Australia and Australians, I'm afraid, over the next little while. And the budget really hasn't solved anything. It's just provided a little bit of tactical help. Power bills, though, will continue to rise and will probably wipe out any of that support anyway. So unfortunately, it doesn't look particularly attractive at the moment. And of course, if international investors start getting twitchy about Australia, then Australia, which has been a proxy for investing in China indirectly for many international investors, that may change. And that could also put downward pressure on the economy as well. So I think buckle up is what I'd say. Buckle up.
Yeah, we're a fantastic test case for history to write about, I think, with household debt and everything that's going on.
Absolutely.
But I'm glad to hear you've settled in and you're having fun in the UK, Martin. Thanks for joining us, and late at night for me and early in the morning for you, but we'll make it work every month for everyone at home. So thanks as always, guys. Hope you've enjoyed the episode, and we'll talk to you again soon, Martin.
See ya. Bye-bye.